Now, bearish order flow, ladies and gentlemen, is a scenario in the market where the net orders in the market is short, meaning that there are more short orders that flow in the market than there are long positions. So in that scenario, the institutions who are making money with shorts are in larger supply, or should I say more offers in the market. The market is going to continue to reach lower for lower prices to continue to offer sales. So now, how can you spot bearish order flow with price action? Now, very similar to how we read the chart on the previous example with the bullish order flow scenario. Here, you have to understand as well that above every high in the market, above every swing high in the market, there are institutions selling that high for whatever technical reason they have. There are going to be institutions selling that high. And above that high, those institutions will place buy stops so that in case the market were to go against them, they would get stopped out of their short positions if the market got to that level. And likewise, below every low, there are buyers in the market. And you need to understand that the buyers, when they buy, they are going to put sell stops below their entries. This sell stops protects them, so that in case the market goes below their entry point and their position is now under the water, they can get stopped out without having to lose a large amount of money if the market were to drop rapidly. So you can see bearish order flow on a chart, and we'll start off with this range. We'll firstly consider this range. So you see right here, this high to this low, right? So let's take that as a price range to consider. And you want to understand what is the range of order, what is order flow from that level. So let's look at it as though it had never occurred. And you understand that price has made a high here and has made a decline further, and we found this low. And now you want to know, is price is going to be bearish or bullish? Well, you want to see, we know that there's going to be buyers buying this low. Those buyers have what? Sell stops under it. We know that sellers sold is high. Those sellers pull what above their entries, they put buy stops. Right. So you know that sellers are going to have buy stops there, and buyers are going to have sell stops, right? So now I told you the principle of order flow when the market is bearish is that you want to see the highs maintained and the lows should get killed. Meaning price should continue to reach for the sell stops below the low while maintaining the highs. And what do you see in price action here? When price continues to move in between that range, price eventually, you see the low of this candle was 64.08. Now price has reached lower than that. Of 64.08, the low of this candle is now 62.60. So now we believe that bearish, the market is bearish, and when price rallies higher, you should be looking to enter for sales. And you see the market continues. So you see what happens here. This high that is formed in the market is protected. When the price rallies here, price did not rally all the way back to that high. Instead, price rallied, failed, and fell lower. And do you see how the lows are constantly taken out? Price, remember that there are sell stops below every low. And price continues to reach. For the sell stops that were below here, got killed. Form new sell stops here because buyers bought and put sell stops below that candle, and they got killed as well. And you see how the buy stops are resting above this high, and above this high, and now above this high. Prices preserving those highs. You see how the buy stops are never getting touched as they get lower, as price falls. But the sell stops that form when the buyers come to the market are constantly getting what? Taken out. Even at this level where we saw many times the buyers protected at low, that the sell stops below those lows eventually gets killed. So this is how, from price action, this is how you can tell when the market is in bearish order flow. You want to see that the lows are continually getting taken out and the highs are preserved. And in a scenario where the low is, and in a scenario where the market violates a swing high, if the market peradventure is still bearish, you want to see a lethargic movement downwards. All right. So from what I've shown you, you will now understand that price action and order flow from price action can be read in the market when the swing high, this high, forms and a low forms. Now, when the market rallies back up in a bearish order flow market, you want to see that this previous swing high is protected, meaning that the current price will not go beyond that high. And you want to see that the low that was previously formed, this low right here, gets killed. So you want to see the market go lower, right? That is what's essentially what we've looked at on this chart. Now the other principle of bearish order flow is, when you pay attention to diagram I'm about to draw, same thing. You want to see the market go lower, form a high, go lower, form a high, go lower. So now what happens in a situation where the market rallies up and trades beyond the previous high, beyond this high that was formed here, when the market does this? So when the market does this type of thing, in order for us to know that the market is still bearish, we believe that if order flow is genuinely going to remain bearish, you want to see a lethargic move downwards to take out the previous low. If this lethargic move doesn't happen and price fails to take out its previous low, then yes, price should continue higher. But in a situation where order flow is bearish and price rallies and takes out the previous high, knowing that the principle of order flow is that the previous high should be maintained and preserved, then you should look for a lethargic move downwards. That lethargic move must occur to take out the low that was formed. If that lethargic move doesn't happen, then price has begun to switch to bullish. And let's see if we'll get one of those scenarios here in the market. Okay. So up until this point, you can see that the highs of the market have been preserved. The market is failing. Okay, so let's look at that. You see how this swing high, the market fails to, actually there's nothing there. So in this scenario, the market has been reaching for sell stops, trading lower, and then we found this low here. And this is a scenario where the market finds a low, rallies, and the rally finds a high here. This high doesn't go beyond the previous high, but when the market tries to decline, buyers find support and push price up again. And this second attempt to push price up goes and trades beyond this previous swing high that's formed here. You see how the high of this candle is actually 52.88, but the high of this candle is 51.97. So when price trades beyond this previous high right here, you suspect that price action wants to become bullish. But the principle of bearish order flow, for us to know that it is going to remain, is that after trading through a previously formed high, you want to see a lethargic move downward to take out the old low. And that's exactly what we get here. So after price took out this high, what do you see here? You see a strong move down. Price rallies back up, and then you see a second leg on that down swing all the way lower, and see how this low gets killed. Beautiful price action.